Hey everybody, my name is Jeb Gerald and I am a financial planner with Plentiful Wealth. Today, I'm going to be talking to you about the economy, the elections, and what I see coming over the next few months and how you can protect your portfolio. Let's jump in. The agenda is pretty simple today. Really, we're going to be talking about where are we now, looking at the economy and looking at the stock market. We're going to also talk about what's driving the market and then what's going to be driving the market, like I said, over the next 6 months. And finally, I'm going to talk about how I'm adapting my portfolios to both protect on the downside, but take advantage of the waves on the upside, because there's always opportunity out there. Before I go any further, though, I do want to take just a second to introduce myself and introduce Plentiful Wealth. Like I said, my name is Jeb Gerald, and I've been a financial advisor for 10, 12 years now, 11 years. It all runs together after a decade. I've got a master's degree in financial planning, certified financial planner, all that. And about 3 years ago, I launched Plentiful Wealth so that I can provide integrated financial planning, specifically tax planning and investment management. Something I saw was missing in the market, particularly for retirees. I love working with engineers. So with that, I will go ahead and say it's the only offer I'll make the entire video. But if you do want a second opinion, they're complimentary. I'm always happy to look over your portfolio and see if I can point anything out or make any suggestions. But now for the reason why you're here. So when I'm talking about the economy, there are three big numbers that come up. The first is GDP, gross domestic product. And that's just simply how much does the U.S. economy or any economy create? Next up is unemployment. Unemployment's pretty simple. How many people are working? What's the percentage of people that aren't working? And then finally, inflation. Inflation is simply when prices go up. When you go to McDonald's and the Big Mac isn't $6 anymore, now it's $8, that's inflation. So I want to break each of those down into more detail. First, looking at GDP. The gross domestic product, I'm going to take each of these and kind of show you big picture. Where are we? How do we stand looking at historical averages? And then, do I see any red flags? Is there anything yellow, or is everything great? And with GDP, looking at this graph, this goes back to 1980 or so. You can see the 1981 early recession. You can see, if you look over on the right-hand side, GDP is right around 3%. I think we're somewhere in that range right now. And 3% growth for a very mature economy is really not bad. Big picture, there are no red flags when looking at GDP. We had a drop in GDP during COVID, and that's where you can see the big spike to the downside came in. But then it really bounced back, and we've moved along solidly and continued to grow since then. So on GDP, it's pretty simple. No worries there. On unemployment, it's a little bit different picture, but it's still not bad. This is more of a longer graph on unemployment going back to 1948. The big takeaway here for you is that unemployment is cyclical. You start out, you have really high employment until you get to a recession. If you look at the dark gray shaded bars, those are recessions during this period. And you can see when a recession begins, unemployment goes up, then it generally peaks right after the recession, and then it begins to drop again. You can even see that in the very minuscule, very narrow recession during 2020, that unemployment, when people got laid off, people couldn't work, inflation went through the roof, unemployment went through the roof. But it dropped and it actually got back down to 3.6%, which is a historical low. So that's great news. Since then, that was in 2020 that we hit that, or 2022 that we hit that 3.6% number. It's gone up a little bit since then. Now we're in the 4.1, 4.2% range. So it's up, that'd be about 16% higher than then, but 16% of 3.6, not 16% overall. This isn't a red flag. This isn't a yellow flag. I would just say it's something to kind of keep your eye on, because if you look, you can see that unemployment is starting to creep back up just a little bit, and it's something just to be aware of. Um, Looking at this is kind of a different way of looking at unemployment, but I think this kind of puts a better perspective on it. And this is the quits number. And essentially, this is the number of, or the rate of folks who are quitting their job. And instead of folks who are looking and just can't find a job or just generally unemployed, this is people who have a job and they decide, oh, I'm going to take some time off. I'm going to quit for whatever reason. And this is countercyclical. Uh, Unlike unemployment, which goes up during a recession, the quits number actually drops during a recession. And it's intuitive, right? Because if there's a recession, it's going to be harder to find a job. If it's harder to find a job, you're less likely to quit the job you already have. And so, what my big takeaway from this is, you see that there was a peak in the quits numbers back in 2022, really 2022 into early 2023. If you were around hiring at all, then you probably heard or you dealt with the fact that it was impossible to find good employees because prices were going up, wages were going up, and you just had to bid employees through the roof to be able to hire people. But since then, really since, like I said, maybe even mid 2023, the quits number has gone down precipitously. And so we're kind of getting back into that same range that we were in mid 2008, which we all know what happened during the great financial crisis. So the big takeaway here is I think the quits report shows a little bit more, gives a little bit better perspective on the overall state of the jobs market than looking at just the unemployment numbers. I think if you look at the quits numbers, my takeaway is that I'm seeing a little bit of weakness, a little bit of softness, and that people are a little bit more worried that they don't want to leave a safe, secure job because they think they have a better option. And that's the kind of thing that can sometimes portend a downturn in the overall economy. But we'll come back to this later. And then everyone's favorite, inflation. This is tracking from when COVID hit, so February of 2020 on. And as you probably, I mean, as we all have recognized, inflation's been terrible over the last 4 years or so. I know that I've got a family of four, and if I go to Costco, I can't get out of there for under $150 or $200. It's just not possible for me. A lot of that has been driven by this inflation because when you look, it peaked in May of 2022 at 8.8, 8.9% year over year growth. That's huge. Now, headline numbers, they've dropped. Right now, inflation's more like 2.8, 2.9% year over year growth. And according to the Fed and according to, everyone on TV, I'm pointing to my TV over here, uh, that's good news, and it is. But the big thing to know here is that prices are not going to go back down. It's actually, frankly, bad if we have deflation. What we're seeing is disinflation. Disinflation is when the rate of growth, when inflation drops, but prices don't actually drop. So the thing about inflation, though, is it's sticky. Even though inflation's going down, it's still prices are still going up. They're just not going up quite as fast. And so the reason why inflation is still hurting us is these two graphs are showing basically the same thing, but they're just different perspectives on it. The blue line is what we just looked at. That's the month by month inflation number. When you're looking at the red, that's actually prices. So something that was priced at $100 in 2020 by 2024 is now 124, 125 ish. So that 24, 25% inflation, if you look at some foodstuffs, it's closer to 30%. That's the number that hurts. And as a consumer, when you look at where most people spend their money, your house is pretty well locked in. If you have a mortgage, you know what your payment's going to be. A lot of us are dealing with insurance that's going up, but overall, you know your mortgage. Same thing if you have a car. Those payments are fairly stable. But food, we buy food every day. We buy food every week. And if there's a sudden shock, or in this case, the it just continues to compound and get bigger and bigger, then that's when it really starts to hurt. So on the inflation side, I think that's a place where I'm keeping my eye out, because as inflation goes, that's where interest rates are going to go. As of right now, we had a 50 basis point cut last month, and then we're not going to have any other opportunity for a cut until next month. Unless inflation really drops precipitously or the economy starts looking very bad, it's unlikely that we have another large cut. If inflation stays basically where it is and the economy continues on, we might have a 25 basis point cut. That's the most likely option. It's possible we don't have any cut at all. So just keep in mind that inflation's still there. It's not gone away yet. And kind of putting it all into perspective, over the last few years, when I look at a couple of different relationships, I'm a big graph guy, I'm a big numbers guy. This is a really good way to put it in, just to show it, that higher spending and flat income translates to more debt. And this kind of goes back to, again, the safety, the stability of the economy. So the things you're going to look at here, the blue line is personal consumption. That's how much people are spending. The green line is disposable income, how much people are making. The difference between the two is the problem. When your income isn't growing as fast as you're spending, that means you're running at a deficit, right? If you're spending $110 and you only make $100, that other $10 has to come from somewhere. And where it really can be seen that it's coming from is from consumer credit, revolving credit like credit cards. And that's where the red line comes in. When you look at credit card growth, credit card use over the last 4 years, it's grown almost exactly, like you can see, in line with the increase in spending. And I don't actually put that at the feet of the consumer, because I think most people are just trying to get by. Too many people are living paycheck to paycheck, and they probably see credit cards as the only way to get by. But when you look at the green line, the income line, there was a spike in early 2021, but since then it's essentially been flat. Real wages haven't changed very much. So overall, people have to spend to live, and that money has to come from somewhere. So next up is the personal savings rate and consumer confidence. I'm just going to kind of hit this one at a high level. Again, I just thought this was interesting. Consumer sentiment is also known as consumer confidence. It's a study put out by the University of Michigan. And it just says, essentially, do you think the economy is going to be better or worse in the next 6 months? And it's given as a percentage. And so that's actually the red line. And you can see that as people think the economy is going to do worse, it drops. So when inflation was at its worst in May of 2022, consumer confidence was also at its lowest. But you can see as a leading indicator of that is the personal savings rate. Because when people can't save, and because they're already too strapped for cash, that means they probably have a pretty poor outlook on the economy as well. So I think this one's interesting just because the personal savings rate moves a little bit ahead of the consumer sentiment. So that way it kind of gives you an idea of where the consumer sentiment is going to be going in the next 2, 3, 4 months. So just kind of interesting stuff. And then talking about leading indicators, this is another one. In the red is, again, consumer confidence study. You've seen that. It's pretty straightforward. In the blue line, this is credit card delinquencies. And it's inverted, though, so just because I showed the correlation better between the two. But the thing to take into account here is, excuse me, when the blue line goes up, the economy is actually better. Or people are actually paying their credit cards on time. Where you see a dip, as in 2008, 2009, that's when people are missing their payments. They're becoming delinquent, 30 days or more delinquent on their credit card bills. So my big takeaway is when I'm looking at this, I see, 2022, there was a ton of cash because we all got checks from COVID stimulus. people were paying their credit card bills. Everything was going pretty well. But as prices increased and as that money dried up and people spent that, that's when you see the line starts to go back down into the right. And more people they're missing their payments. It's up into the 4% range these days, 4.5 or so. And so, again, that's a leading indicator that there is pressure, there's pain in the economy, and that the spender is having, the consumer, they're having some problems. So that leads me into why the consumer matters. And the short answer is when you're looking at GDP, there are four things that go into it. And the biggest one, 68.7% of GDP, is driven by personal consumption. That's us, you, me, all of us going out, eating food, buying houses, buying cars, buying clothes, spending money on services, any of that. That's all reflected in GDP. So you can imagine that if I and all my friends or whoever stop spending, or even if everyone cuts their spending by 10%, all of a sudden that GDP is dropped by 6.8% overall. That's a big deal. So this is why consumer confidence matters. And that's why I'm spending so much time talking about it. So big picture, putting it all onto the economic scorecard, GDP growth is good. In the 3% range, I'm not worried there. Everything looks fine. The unemployment numbers are still pretty darn close to historical lows, but because the quits numbers are showing what appears to be some potential weaknesses there, I rated a little bit lower. And then inflation is, again, a mixed bag. Inflation's down, headline numbers are down, but we're all still feeling the pain from higher prices, and that's hurting people when they're actually going out and they don't have as much money left over after buying food and the necessities to go be spending elsewhere. So overall, I'm not going to give our economy a grade because I would be a terrible teacher and I don't really want to do that. But that does give you a pretty good picture of where we are right now. Now, let's move into the stock market because you've got the economy, and the economy drives the stock market. Essentially, the stock market is if the economy does 3% per year in an average year, bad year does 2, good year does 4%. The economy is essentially, or the stock market is essentially the economy using leverage. And what I mean by that is instead of getting 3% in a regular year, the stock market will average 7 or 8%. So from there, let's look at where we're at this year in 2024. Good news. If you own stocks or any other asset, you're probably having a pretty good year. Gold is up more than anything else. It's up over 30%, which is pretty darn good. When you look at US stocks, emerging markets, European, international bonds, everything's up this year. The only thing that is not up is Brent crude. So talking oil, and it was up almost 20% at one point, but it had a spike back in May, and then there's been some demand weakness across the world, and so the prices dropped. But across the board, other than oil, it's been a pretty darn good year so far. Breaking it down just a little bit more, I don't have the year-to-date numbers here, but for the one-year numbers, almost every major indice in the United States is up, 29, 31, 38, 42%. For 12 months, 42%, that's hard to argue with. And that kind of brings me to the point that market valuations, because people, when we get to all-time highs, we've had 3 down days in a row. The market was off the NASDAQ was off almost 2% today. But when we're at all-time highs, people start worrying a little bit. I understand, we've all done it. I've done it, because you start wondering, how much longer can this go on? And this is kind of a pretty good perspective on that. Talking about valuations, because sometimes the market can continue to go up and valuations are reasonable, and the market's going up because companies are earning more. Their earnings are going higher, and and that's a win for everybody. That's a great thing. But sometimes stock prices go up, the market goes up because multiples go up. And essentially, it's the multiple is just the valuation number that is attached, multiplied by the earnings to get the stock price. And this chart, the big takeaway here is whenever you look at any of the major peaks, you can see one in 1929, you can see one in 1937, then in 67, if I remember correctly, 2000. These are market valuations. And this is saying, is the market overvalued or undervalued? Or is it a fair valuation? Sometimes it's undervalued, sometimes it's fair. When we're looking today, you can see in 2020, actually it's in 2021, that the market was 160% overvalued. And this is an average of 4 different valuation indicators, which you can see up at the top. It was, 3 standard deviations overvalued in 2021. We're not quite that high here in 2024, but we're still pretty high. It does bring up the question, will there be a reversion to the mean? Will we move from, significantly above overvalued to back to regular valuations? And that I really can't say. But I can put some numbers and show you how have high stock valuations performed in the past. And the big takeaway here is that low stock valuations generally portend well for the stock market, whether you're looking at a 1, 3, 5, or even 10-year time frame after that low valuation. But on the high valuation side, the answer is not quite as clear. There are 4 examples here you can see from 1999 with the tech bubble, 2018 with that was the flash crash. No, I'm sorry, that was actually it was a flash crash. 2021 and 2024. And in 99, in the 3 years after that, the market was down. But in 18 and 2021, the market was up over those following 3 years. So it's kind of a mixed bag. And just because stocks are high now doesn't mean they can't go higher. The big takeaway here is we just really don't know. And one of the biggest parts of investing is figuring out what's signal and what's noise. Because if you read Barron's, Bloomberg, Fortune, any of them, you'll see so many different charts. And I'm guilty of it. I've thrown many charts in here already. But when you have all those charts, sometimes it's hard to say, is this something I really need to pay attention to? Is this actionable? Is this something that I need to go and implement in my portfolio? Or is this just kind of interesting? And to be honest, this chart, I want to show you because I think it's important to know that, hey, this is kind of interesting, but for me, this isn't something I would take action based off of. It's good to have all the information, but being able to filter it is so important. So going forward, we talked about where the economy is, and I've talked about where the stock market is. And now why you all are probably here is you want to know where's the market going forward and how is the election going to impact the market. So breaking the market forces down into short and long-term factors. Short term, the presidential election is right around the corner. Geopolitical forces, they're always an issue. I could have put that across the board. Long term, you will hear all of these again here in a minute: changing demographics, AI revolution, energy infrastructure, and global political realignment. I'll talk more about those here in a few minutes. So looking at the presidential election, and this is where it goes back to signal versus noise. I've seen some really cool graphs that really broke down every bit of volatility around the presidential election, how every single election year, what the returns have been, what performance, how volatility in an election year affected 3-year returns thereafter. And frankly, I don't think any of that matters. My biggest takeaway from the election is right in this chart. And this chart shows that it doesn't matter whether it is a red or a blue president. The stock market is based on the American economy. You are betting, or you're not betting, you are You expect that the American economy is going to continue to grow. As long as you think that is going to happen, the stock market's going to be fine. It doesn't matter who the president is. Because at the end of the day, the president doesn't have a huge impact on stock market returns. Some would probably say that that's heresy, but I'm very confident in saying that. Because when you're looking at stock market returns, I mentioned this earlier, but they're driven by two things. The first is earnings and profit. Well, really three things: earnings, profit, and then the multiple. Earnings, all three of those are not really impacted by the president. At the end of the day, the only thing that really is impacted by the president is short term and how people feel about the market. So, how people feel on a day to day basis, that can absolutely change. If you look back to 2016, when Donald Trump won, the market had a pretty big reaction because it was unexpected. The market hates uncertainty, and it also hates surprises. And so when you have an event that's unexpected, that's not priced in, so to speak, that's when the market reacts. And depending on the outcome of the election coming up, we could have some volatility from that. But it's not because anything fundamentally has changed in the economy. It's because it's hard to price in uncertain events. So as of right now, Donald Trump is, by the polls I've been looking at, and I'll show these here in a minute, Donald Trump has about a 62% chance of winning. And so it's likely to say that the market is priced in the probability of a Trump win. Take that away and say that Vice President Harris won, then the market would probably have a reaction. Good or bad, honestly, I don't know. But they would have a reaction because it's unexpected. And at the end of the day, it's hard to price unexpected events. Big picture here, your portfolio is better off when it doesn't take politics into account. If you can step back and just invest because you believe in the American economy, because you think that we can continue to grow, you're going to be better off. Ignore the noise, focus on the signal, focus on what's going on here in our economy. So breaking down each of the candidates' economic proposals, I want to keep this pretty high level because people can spend all day on this, and frankly, I don't want to get political any more than I have to. If you can figure out my politics from this, I apologize because that is not my goal. But I want to go ahead and throw these out here so you have a big picture idea of what's going on. So looking at Trump's economic proposals, they can be categorized into four different areas. First is tax cuts, and this is one of the biggest parts of his proposal, and just cutting taxes across the board. The 2017 Tax Cuts and Jobs Act was a landmark piece of his legislation, and he wants to go ahead and extend those cuts. As of right now, the tax cuts are set to expire on December 31st, 2025. Unless extensions are voted through Congress, they're going to go back, and we're going to be paying taxes just like we were in 2016. That means a lower standard deduction. That means exemptions, credits, all that stuff that we don't really deal with as much now. Way more people are going to be itemizing because of the lowered standard deduction. So, and also rates would go up. So that's one of the biggest hallmarks of what he wants to do. He has also proposed eliminating taxes on Social Security benefits, tips, and on overtime pay. Overall, I think those will be good to the folks who are affected by them. As far as how they would affect the economy, honestly, it's probably not a huge difference either way. And then eliminating the SALT cap. SALT is state and local taxes. This is state taxes, any kind of taxes you're paying on your house, anything like that. Right now, those are capped at $10,000 that you can itemize as a deduction. What he's proposing is eliminating that cap. And so for high income earners who are paying a lot of state taxes, especially for people who are living in New York or California who have exceptionally high taxes, or for people who live in areas, even Texas, that have really high property tax rates, this can be a way of lowering your overall taxes. Next up I'm going to skip tariffs and trade. And I'll come back to that in a second. Energy and cost of living, really just deregulation across the board, so that there are more ability. It's easier for companies to mine or drill or get fossil fuel out of the ground, however that might be, to overall lower the cost of energy. That's the goal. Uh, Looking back to tariffs and trade, and I think this is the biggest, honestly, the biggest part. He's put forth a universal 10 to 20% tariff on all imported goods, and then a total 60% tariff on Chinese goods. I don't know where you shop, but most of us have a lot of Chinese goods in our house. The potential ramification here is if there's a 60% tariff on goods from China or 20% coming from France or whatever that might be, those tariffs are going to be passed on to consumers. That's how tariffs work. If there's a 60% tariff on Chinese goods, overnight, that whatever that widget is, that toy, that anything you ordered off Amazon, it's probably going to go up by 50%. Might not go up the full 60, but at the end of the day, producers aren't going to continue making things and selling things if they don't have any profit in there. And if you slap a 60% tariff on something, that's that's more than most producers' profit margin. So goods will go up. That will hit inflation. That'll hit our pocketbooks even more. Now, the flip side of that is it could also spur American manufacturing, and that's the hope of it, because we do need more manufacturing here. Right now, our entire supply chain comes through China or Southeastern Asia or so many other places, and we have as we saw during 2020, we have issues with our supply chain and the fact that it's not very flexible. It's really meant to, with just-in-time manufacturing, it's meant to have exactly the goods you need, when you need them, where you need them. But if you have a wrinkle at any point during that supply chain, those wrinkles, those ripples just flow through and they become waves or even a tsunami. So I can see the benefits here, but just know that there are costs to tariffs like this. Same thing for a crackdown on the border, that so many people, lower paid employees, physical manual laborers, might not be here legally. And so if they are no longer here, and wages will likely have to increase, and that's going to have an effect as well. Wages increase, that's going to be passed on to consumers. So again, not saying good or bad, just saying that there are costs and benefits to everything. Now for Vice President Harris's economic proposals. Her platform is really based on reducing the cost of living and supporting the middle class. That comes through housing, taxes, and minimum wage, essentially. On the housing side, a couple of these ideas are pretty decent, and then some of them not so much. Uh, so the first point is building 3 million new homes. I think that's great. Right now, we have underbuilt homes in the U.S. for the last 40 years. And when you look around, I'm a millennial, and I know so many of my uh, friends and family have essentially decided that they're going to be renters for the rest of their life. Or I say decided, they've accepted that they're going to be renters because they're never going to be able to own their own home. And a big part of that is because not enough homes have been built. And so, with the way house prices have gone over the last few years, I mean, it's been great for people who own houses because your equity has gone up, house prices have gone through the roof. But it's not enough to say, 25,000 down payment assistance. I'll come to that in a second, because that's just going to push the prices even higher. You have to bring new supply into the system. So how to do that? Frankly, I'm not sure what the plan is behind that. I've heard a couple of different ideas. At the end of the day, you have to make it cost efficient and a net positive for home builders to be able to put money into building those homes and then selling them. Next up is looking at the 25,000 down payment assistance. This one's kind of tough because just like with some of President Trump's ideas, this one's going to have second and third order effects that I don't know that we really know yet. Because if you give first-time home buyers a $25,000 down payment assistance voucher, credit, grant, whatever it is, that means the entire market's going to be pushed up. Uh, a new home that would have been 150,000 before, it won't be 175, but it might be 165 or 170. And the second order effect there is twofold. The folks who already own their own home or have bought a house in the past but are currently renting, maybe they had enough down payment to buy that $150,000 house, but now that it's 165 or 170, it's out of their reach. So it doesn't really help much there. And then the other side to it is the people who are buying $170,000 houses before this are going to get pushed out of the market because they're not going to have that assistance. They're not going to have that size down payment. And it's going to push everyone up market and kind of crams the middle class. And so I think there's some pretty big downsides to that. And then finally, her third point is restricting large investors. When you look, I believe I saw it earlier, was Blackstone is the country's largest rental home provider. They're a private equity firm. And this has happened, it's happened for a long time, but more so in the last 20 years, 15 years, that private equity has come in and bought up thousands of homes across the country, and they're landlords now. And so she's proposing that large landlords like that be restricted. On the tax side, she has proposed that the child tax credit be expanded, and it's expanded especially for newborns up to 6,000. This was also mentioned by JD Vance, so there's probably some bipartisanship possibilities there. Same thing for ending the taxes on tips. And then she's also proposed raising the small business tax deduction to $50,000. And then the final thing is the minimum wage, because she proposed, and she's really just started talking about this in the last couple of days, a $15 federal minimum wage. Right now, it's $7.25, I believe. It's been the same thing since I was in high school 20 years ago. And inflation's happened since then. It's really hard to live on that. But to be completely honest, I think many, at least in my area, even fast food places are paying $14, $15, $16, or even more if you work at Chick-fil-A. So it's likely that, honestly, that probably won't have a huge impact either way, but it's not a bad thing. So when you're handicapping the election, and I know that sounds terrible, but there are a couple of places you can look. You can look at the betting markets, places like Polymarket, Predicted. There are a ton that have come out in the last couple of years, and this is where people actually place bets on who's going to win the election. Or you can look at polls. Nate Silver's 538 is probably one of the most well-known. There's Gallup. There's so many polls out there. Personally, I like looking at the betting markets because I think it is more accurate that if someone actually puts their money on their belief, I think that's more indicative and more predictive of actual outcomes. So looking at Predicted, for instance, this is today's prediction. This is today's market, and Donald Trump is nearing a 60% chance of winning. I think he's 59, 60%, right around there. The biggest thing I take away from this is looking at the swing, though, because when you look from mid-September until today, President Donald Trump has gone from 46, 47% chance to 60. That's a huge swing. And so I look at this as, does he actually have a 60% chance? Does he not? I don't know. But I do think that the predictive value is in the swing. It's directional, saying that he has surged in the polls over that time frame more so than saying, it's specifically this percent chance that he wins. So I do think that's pretty interesting. Compare that with polling data. I pulled this from Nate Silver's 538, like I mentioned. He's one of the best in the business. He aggregates a bunch of polls into his own specific model. And this is looking just at votes. Who is polling higher across the nation? Right now, Vice President Harris is at 48.8%, President Trump 47.2%. Couple takeaways for this on this for me include that's still within the margin of error either way. It's not that big of a difference. So according to this, I'd say it's kind of a toss-up. But what this isn't taking into account is the Electoral College, because at the end of the day, we live in a republic, not a true direct democracy. And so you can have 51, 52, you can win the popular vote, but unless that candidate gets 270 votes in the electoral college, it doesn't matter. So that's again why I prefer the predicted market as opposed to actual polling data. So areas I like to watch going forward. Actually, let's skip that one. Um, Talked about the election. We'll talk about geopolitical risks for a minute, and I'm getting pretty close. I got about another 5 minutes, but I want to finish these up. Geopolitical risks are honestly the biggest thing I'm paying attention to these days. The economy it's moving. It's not bad. We talked about that. But when you look at recessions historically, they don't come out of nowhere. Um, they're not caused just by an economic slowdown that gradually happens. Instead, they're caused by shocks. Could be an economic shock, which was, a good example of that was 2007, 2008 with the housing crisis that people didn't really talk about until all of a sudden it exploded and Lehman Brothers went out of business, Merrill Lynch was sold, all these different things. Bear Stearns went out. Or it could be like 2001 with 9/11. So 9/11 happened going into 2002. There was a short recession, which was essentially caused by the bubble popping, caused by caused by the terrorist attack. So looking around the world, I think there are a couple of big hotspots that I want to highlight. Some of these I know you're probably familiar with. If you're looking at Russia and Ukraine, there's a star up near the top center, and we all know what's going on there. One of the things I am kind of concerned about is it seems to be escalating some. It's been easy to forget about it. It's been 2.5, coming up on 3 years now, and in a lot of cases, it's devolved into trench warfare, and it's ugly. But it's just ugly. And it's easy to forget about because of that. The worry there is there's a couple worrisome parts. First is the potential that Vladimir Putin looks at the world and thinks that this is an existential crisis for him. He doesn't have the most solid grasp on over control of the country, and he's getting a little older, and there is a potential that something could happen, that whether Ukraine puts enough pressure on him or they actually make an even larger incursion and take more of Russia, and that puts enough pressure on Putin that again he just feels like he's losing control. Uh, the potential escalation there is tactical nuclear weapons. I don't think that's likely. I'm not, that's not my biggest worry, but it's something that's out there. If that were to happen, it would probably have a limited actual effect as far as a physical effect, because most of the tactical nuclear weapons have a relatively low yield, but it would have a larger effect on the geopolitical world, because that would ratchet up, sanctions to an unheard of level. Because as of right now, Russia is actually in a pretty decent place economically, because they're still selling their oil to the Chinese, to Indians, a couple other countries. And I think that would actually stop if a nuke was used. So that's one thing I'm watching. China and Taiwan, I've talked about this a lot. So I won't get too far into that, or China and the Philippines. But again, there's a lot going on in the South China Sea. Long term, that's a hot spot that I think something will come out of. North Korea and South Korea. Kim Jong Un he's gotten a little peppy over the last few weeks, and really in the last week, that he is put more of his troops on the border on alert. He has increased exercises, and he's actually been firing even more rockets. My expectation there is that it's nothing that he's actually trying to do except for ring a bell, get some attention, and get some attention, especially leading up to the U.S. presidential election, after he had what seemed to be a fairly okay, cordial relationship with President Trump. And so, in the past, the way this usually worked is North Korean leader will, ring a siren or do whatever, and then there will be a detente, and then we'll reduce sanctions, or we'll ship food, or we'll send grain, whatever that looks like. But essentially, they make a threat and then they get paid off. That's just the typical cycle. And that's probably what I would expect this to be as well. Um, Big picture, though, my biggest concern is still the Middle East. Looking back to the price of oil earlier, you know, it's down on the year, but the biggest concern to the supply is the Middle East, because Iran is currently waiting on Israel's retaliation strike from Iran's last strike a couple weeks ago. Uh, I thought that would have happened already, but what's almost scarier is that Israel's taken more time to focus on Lebanon, bombings in Beirut, going through, and I mean, they've actually wiped out Hezbollah's entire command structure. But the other thing that they've done is they've spent this time building a coalition on the backside. Because when you look at Iran, Iran's a Shia country, and they're one of the really two majority Shia countries in the Middle East, three, I guess. So you have Iran. Iraq is also a majority Shia, although they have a very large Sunni presence. Saddam Hussein was a Sunni, and they were ruled by Sunnis for years. But now they're very well mostly Shia and have a whole lot of influence being felt from Iran. And then Lebanon is also Shia. And then Syria has Shia as well. But big picture, right now, when you look at Saudi Arabia, the Gulf countries, Kuwait, and Egypt, they're all Sunni. And there's been a historical animosity between Shia and Sunni. And when you look at the power dynamics in the Middle East as well, Saudi Arabia and Iran have always both wanted to be the regional hegemon. In fact, there's a really good argument, I talked about this back last October, that the October 7th attacks in Israel were prompted by Iran as a way to drive a wedge between Israel and Saudi Arabia, because they're having talks about normalizing relations. So it's really kind of, it'll be interesting to see where things go. The big question there is, what is Israel going to target? They have a few options. They can target, they have a lot of options, but they can target military targets. They can target Ayatollah Khomeini or other IRGC leaders, or just Iranian leaders in general. They could potentially target the nuclear facilities. That would be a very big step, and that would be something that the Iranians see as, again, a very escalatory action. If that happens, who knows where it goes. If they target primarily bases that were used or to launch rocket attacks, that's probably seen more as a regional tit for tat, and Iran might not do as much, or they might not do anything back. But if they attack oil facilities, such as in the Gulf, or if they attack nuclear facilities, those are big red lines according to the Iranians. So a lot to keep in mind here. Just keep watching the news and seeing what's happening. So talking about the stock market reaction, here's my big picture outlook. I think we're going to see an economic slowdown over the coming months. I think over the next 6 months to a year. I thought we were in a recession last year. I was too early. But I still see that we're moving generally in that direction. That doesn't mean the market's going to drop. That doesn't mean anything like that. It just means the economy is going to slow down. I think that the geopolitical shock, whether it's coming from the Middle East, from the Far East, or from Europe, I think that's probably what will actually cause the beginning of that next recession. And then finally, this is my advice, and this is what I've been doing for my clients, that since we're still near all-time highs, it's not a bad time to rebalance. And where should you rebalance? Where am I looking? Here are my thoughts. One of the biggest things I'm looking at are equal weight indexes. So if you're looking at the S&P 500, you can buy any number of ETFs that track the S&P 500. Typically, those ETFs will be cap weighted. What that means is not every single stock has the same percentage within that ETF. Instead, they look at it and say, okay, Microsoft and Apple are huge companies, so they're going to be a bigger part of this ETF than this tiny little telecom, which will be 0.001% of the ETF. So what we've seen, what I've seen over the last really 6 months, 10% of the S&P, the 10, sorry, not the 10%, the 10 largest stocks in the S&P make up over a third of the ETF, a third of the index. And so that's a ton of concentration. That means that if any of those big stocks have a bad day, that there's a lot of contagion risk that can spread and that can hurt the overall returns of the index. So what you can also look at is an equal weight index. Instead of having 500 individual stocks of different sizes, you can have each of those stocks equally weighted, and that way it's better representative of what the entire index does as a whole. So that's something I like. Japanese stocks. I've been a fan of Japanese stocks for the last 6 months or so. One of the big things that they're working on in Japan is changing their system. Essentially, the government's pushing their savers to become investors, and that makes an opportunity for owners of Japanese stocks because it's more inflows into those companies. I like AI. I think right now we're in an interesting place where so many people expected that AI would immediately have returns to companies. I'm not talking about investment returns, but I'm talking about companies that are investing in AI for their own companies. And frankly, we're really not quite there yet. The big thing about AI that I think is interesting is where it's going to be in the next 5 years. Because if you think about a great analogy, a great correlation is 1999. Everyone knows pets.com. Everyone knows those first generation of internet companies that so many of them they were flash in the pan. Their stocks went up and then they didn't have anything to actually back it up. But what you saw was the companies that were in that first wave and then they survived and then they became thriving companies or companies that now we look at like Amazon, that they have great businesses and they're a huge part of our ecosystem. And I think we're going to see the same thing from quite a few of these AI companies, that there's going to be a pullback at some point in AI stocks. People are going to become disenchanted with them. But, when that happens, we're going to figure out which of those companies are really good quality and will be sticking around. Likewise, I think I think the better play right now is AI infrastructure. And by that, I mean looking at the chips, looking at the manufacturers, looking at energy utilities. And I talked about this down here, number 4, the energy transition, because when you're talking about AI, to run a query on ChatGPT versus Google, it takes orders of magnitude more energy to process it through ChatGPT. It's a huge difference. And the issue that comes up there is these huge data centers. There's a ton of them in Northern Virginia. They require so much energy that they're actually constrained by the local electric system because the power grid can't grow fast enough to get all these new data centers online. So I think we're going to be seeing a lot of changes here over the next few years. Over the last couple of days, actually, I guess last week, it was announced that 3 Mile Island, which everyone knows is the site of a nuclear disaster. I don't remember if it was Google or Amazon or Google or Microsoft, but one of the two is putting money into that to get it restarted and to buy their energy. And when you look at China, they are producing over a terawatt of energy using nuclear power. I think nuclear is going to be a huge step forward in our future. So over the last 20 years, people have talked about green energy. And I think that has some place. I think solar particularly has some great options. But nuclear is going to be great. And honestly, no, I wouldn't exclude natural gas and coal over the next few years because when it comes down to it, we have a ton of coal-fired power plants that are sitting there unused or in the process of being decommissioned. That there are going to be some companies that go in there, turn them on, just so they can go ahead and feed power for those data centers. Geopolitical fragmentation and economic competition. I talked about this with China. We're turning into a multipolar world. Coming out of World War II, we were a bipolar world. We had the United States as the Western hegemon. We had the Soviet Union on the Eastern Bloc. Fast forward to 1989, 1990, the wall came down. USSR became Russia again, the Russian Federation. And then we were a unipolar world. The United States was the only superpower, the only hegemon. That was it. And really, over the last 15 years or so, starting, I guess you could say, starting in the late 70s with Deng, China has modernized. They have modernized their economy. They're to the point where they are modernizing their military now. President Xi has said that he wants to be competitive with the United States by 2031, 2032, I believe. And so they're showing that they're more than a paper tiger. They want to have the ability to compete with the West. By some metrics, they are, by most metrics, they're the world's second largest economy, but by a few, they're the world's largest economy already. So China, we're in a new great power competition with China. And I think that's only going to continue as we go forward. You see that China is building a block around North Korea, Iran, and Russia, but then also add in a lot of the countries that are in the global south, emerging markets like the BRICS. I say the BRICS, I'll leave out India because India is a really interesting option because they're kind of unaligned. As of right now, they're walking a tightrope between the East and the West, and it'll be interesting to see which way they end up going. But fragmentation is going to be huge. Over the last 20 years, when you look at most of the fact we've had super low inflation for the last 30 years, it's been 1.5%, 2% per year. So much of that is attributable to the low, cheap cost of goods that we receive from China, now from Vietnam and all the other Southeastern Asian countries. If that goes away because the world's fragmented, again, goes back to inflation. And then the last one, I've worked my way up from the bottom, sorry about that, but it's demographic divergence. When you look at economies across the world, they're all aging. You'll see that baby boomers are the largest demographic in most countries. If you look at Japan specifically, there are more adult diapers sold than baby diapers. And that's an extreme example, but that has a lot of potential future ramifications because when you look at how people spend throughout their lives, first 20 years, people are working, they're not working, they're just consuming. But from age 20 till age 60 or so, that's your peak earnings years. That's where you are working, you're saving. What you're saving, you're investing back into the economy, whether that's through stocks, bonds, real estate, wherever that goes. But then once you hit 60, and for round numbers, maybe you're retired at 65, 70, or whenever. But at that point, you're not working and you're living off savings. And so instead of contributing to your investments and your savings, you're pulling from them. So that ends up being between that, Social Security comes into play as well. You have to have enough folks who are, I hate to make it sound like Social Security is a Ponzi scheme, but you have to have enough workers who are still paying in to pay out those benefits to retirees. And so it's going to be really interesting to see the changes that happen over the coming years. I mentioned Japan. Luckily, the United States is kind of middle of the pack. We're younger. We're on the younger side of things. France is another country that has pretty good demographics. China has very bad demographics. Russia has terrible demographics. And so some of these countries are going to be in a really bad place where they don't have, the cohorts that are the younger workers, they're just not there. So that's about it. I appreciate your time. And if you have any questions, drop them in the comments, shoot me an email, jeb@plentifulwealth.com. Thank you so much.